Welcome to this Steadyhand Mid-Year Review 2017 edition. I'm Tom Bradley, President of Steadyhand Investment Funds, and joining me today is Salman Ahmed, my investment partner. Together, we're going to take you through the forces that are impacting your portfolio. Salman's going to show you how you've done, and then I'll spend a few minutes at the end looking forward and talking about how we're positioned for the future. Now, as we prepared for this, we couldn't help but be struck by how different it is from last year's mid-year review, almost exactly the opposite. Last year, we were frankly, a little defensive. We'd had a softer period of performance. We'd just been hit by Brexit. That was fresh in our minds, and in general, our exposure to Europe had been holding back the portfolio as we went forward. It was also a time when, with all that uncertainty, we had interest rates hitting their cyclical lows. I think the 10-year bond in Canada actually hit slightly below 1% for a few minutes. So it was a very unique time, but today it's a much better picture. We're going to show you today that absolute returns have been good, our performance has been excellent, and as much as there's been all that uncertainty in the world, things have been pretty good out there. Now, one of the things we hear, and I think Salman, you've said this to me, that the odd client has said, well, geez, it's, the markets aren't doing anything. I don't imagine I've made much money, but that really is very much a Canada-centric comment. As you know, we have that exposure in our country to resources in general, and specifically energy, and with the oil price going down, the Canadian market indeed has been flat so far this year. But if we look beyond our borders, there's some pretty good things happening. And in general, we've talked about this in our writing, there is, for the first time in a long time, synchronized growth around the world. North America is growing as it has been for a few years, but Europe finally is bubbling up, and there's a very broad-based recovery going on in Europe. And of course, China continues to grow, and even Japan has picked up. So we have we've had very good returns, and I just want to remind people that the portfolios are very global in nature. Yes, what happens in Canada is important, but what's going on beyond our borders is even more important. So Salman, I'm going to turn it over to you, get into the details of how the portfolio is done.
Thanks, Tom. And you're right, that synchronized growth that you've just referred to has had an impact on all our clients in some way, really. That's because most of you, our clients, hold a balanced portfolio. You hold bonds, Canadian stocks, and foreign stocks, either through holding our building block funds, which are those 5 in red you see there, or through holding the Founders Fund, which also owns those underlying funds, but in a proportion that equals about 60% in stocks and 40% in bonds and cash. And for the purpose of this presentation, I'll just focus on the Founders Fund, but keep in mind that my comments apply to all our balanced portfolios, really. Now, when we look at the Founders Fund specifically, it's returned 9.2% over the last 12 months. And those returns have primarily been driven by stocks. As you can see here, bonds, as represented by the FTSE TMX Canada Universe Bond Index, it's quite a mouthful, has been flat over the last year. But Canadian stocks, and even more so foreign stocks, have risen sharply. That pattern applies to our 5-year returns as well. Over the past 5 years, the fund has returned on average 8.8% per year, meaning $100,000 invested 5 years ago would have been $152,000 at June 30th, 2017. And some of you would have done even better if you were able to take advantage of our fee rebates. Bonds have been the diversifying part of the portfolio. They've helped dampen some of that volatility, while stocks have provided a lot of that return and juice in your portfolio. And that's especially the case for foreign stocks, which make up a significant chunk of your portfolios. You can see here more than half of the stocks in the Founders Fund are non-Canadian. And that weight has come down over the last year, especially as our managers have trimmed some of their gains. And this applies to all of our clients in some way, because all of our funds, except the income fund, have some foreign content in them. But much of the foreign content in your portfolios comes from our global equity fund. And the manager of that fund, Edinburgh Partners, have preferred European and Asian companies as opposed to US companies. And we've all felt some pain from that over the last few years, as US stocks have been among the best markets in the world. But that decision to invest in Europe and Asia has really started to pay off recently. For example, Japanese and German equity markets have gained more than 30% in the last 1 year. And I realize that's a short time period, but I think it's worth noting that because the tide seems to be turning somewhat. Your portfolios have also benefited from the industries they're invested in. That industry exposure looks quite different from what most Canadians are used to seeing. That's a lot of energy and a lot of mining and basic material companies. Whereas we hold some, but not nearly to the same degree. That's because our portfolio managers, I should say, don't see the same attributes that they look for in these two sectors. Again, this would apply to most of our clients and not just those invested in the Founders Fund. Instead, our managers have found more opportunities in financial services and industrials. Now, most Canadians, when they think of financial services, they think of the banks. And those banks tend to be a big part of most Canadians' portfolios, but those are very highly correlated to one another. And instead, your exposure is more diversified. Yes, TD is a large holding, but you also hold European banks, Japanese financial institutions, emerging markets, even one in Latin America. And each of these has a unique return opportunity based on either where it's domiciled or just changing fundamentals within the company. Now, when we look at the industrial sector, it's even more heterogeneous. It's comprised of transport companies, consulting, construction, chemical. Basically anything that doesn't fit neatly into one of the other sectors falls in industrials. Now, when we moved to the bond part of the portfolio, well, this has been a little bit more challenging because the environment has been more challenging. As Tom mentioned earlier, bond yields have risen sharply. And this isn't good when you're a bond investor. When bond yields rise, bond prices, and hence returns, fall. But if you've been reading our communications to you, and I know many of you do, you've been prepared for that rise in yields. And Tom, I'll hand it back to you to talk about what we had done in the Founders Fund to get ready for that rise in yields, but also how our managers and we're positioning the funds in general.
Well, let me start, Salman, by talking about the sort of the long-term target of the Founders Fund, which is 60% stocks, 40% bonds. You mentioned that. As we look at it at the end of June, and this is fairly consistent with how it's been over time, you can see on the bottom part, the fixed income side, we've split. Instead of having all bonds, we've had a much more, a lighter weighting there. This is kind of our minimum level in my mind, 25%, and diversified it by holding short-term notes, bank paper, things like that. We call it cash. We do that because with rates where they've been, there's risk in the bond market. When rates go up, as Salman has said, prices go down. And so we've tried to diversify away from bonds. And so most of the cash holding over the years has been relative to bonds. But you can see on the top part of this chart that the equity weighting is now below 60%. A year ago, it was roughly 10 points higher than this. But we've been gradually bringing it down as valuations have got more rich and the stock markets have been going up. So this is essentially a pretty conservatively based, diversified portfolio. Still lots of equities to give you that octane that generated the returns you saw. But with that cash level and the equities a little lower, we are a little more dialed down. And you might wonder why. You know, we're cruising along, it's very calm and quiet, and the markets are going up. But I love this cartoon, reminded me of my younger days in Gilligan's Island. But Suffice to say that we do think that we're going to have some rougher waters ahead, maybe even a little mine or two under the surface that we're going to have to deal with. And so we're very much suggesting that our clients buckle up, make sure their seat belts on, because it won't always be this quiet. So to give you a sense of where I'm coming from on this, I'm going to use a framework I use consistently, which is to first look at the fundamentals, the big picture, economics, politics, etc. How's that impacting corporate profits? We'll then look at the price we're paying for assets, and then finally a quick note on the mood of the market, which my Gilligan slide really refers to. First, the fundamentals. Now, a reminder, as much as every day we read in the paper about the T word or Brexit and what's going on, in the macro picture and what impacts markets, it's very broad. There's forces pulling in all directions. And so we never try and get too cute in making a really bold call on where the fundamentals are going, because there's just so many factors we have to weigh in. Our overriding view, though, is shaped by these three factors, which are certainly governors on economic growth. First of all, the Western world is getting older, unfortunately. I can relate to that. We have fewer people in those working years, the prime working years, compared to the retireds than we used to. So that is going to hold back growth. Debt for sure is going to hold back growth. We've been juiced. We've had our growth juiced by debt over the last couple of decades, but we're getting spent out on the consumer level and even the government level. And then finally, productivity, despite all our technology these days, has been very disappointing. Productivity speaks to the amount of production per an hour of labor, and the growth there has been very modest. And so, as much as Trump can talk about getting things going and everybody can have expectations of more rapid growth, I think the more subdued growth we've had so far this cycle is more the reality based on these three factors. But what shapes our positioning in the portfolio and what our managers do is much more rooted in valuation. We think the single most important factor in determining how an asset is going to perform for you is the price you pay when you buy it. And Howard Marks, this is a quote I use quite often, I think captured it well. He says, no asset can be considered a good idea or a bad idea without reference to its price. So let's look at your portfolio and divide it into two. First, we'll look at the secure, kind of safe side, fixed income, and then we'll talk about stocks after that. Now, when we think about the fixed income markets, I'll start with this very content woman sitting in the green chair. The banks are falling all over themselves to lend her money, mortgage, home equity loan, car loan, credit cards, you name it. She has it available to her, and at really low rates. In other words, it's a wonderful time to be a borrower right now. But as investors, we are lenders. And when you buy a bond or a GIC, you're lending to somebody. And so you flip that over. If it's such a great time to be a borrower, it's not the greatest time to be a lender. And the numbers certainly bear that out. This is a stat that we think is overwhelmingly the most important one to look at when we're assessing fixed income markets. It's called real yield. This is the Government of Canada 10-year bond yield minus inflation, or the CPI. And typically, bond buyers expect to get their money back at the end and a return that is in excess of inflation. But you can see in recent years it's been even a negative real return, and right now it's around zero. So we don't see the value. That's why we have some cash to diversify away from bonds. We think there's some risk there. And we'll continue to do that going forward, although rates, I must say, have moved up here recently. Now, when we look at the stock side, I like to use this retail analogy. It's kind of like going into an Apple store. Whereas normally you go into a store, there's a bargain bin and there's for sale signs everywhere, But in an Apple store, as you know, nothing is on sale. And that is very much what we're hearing from our managers. They're just having trouble finding anything that's very cheap. And the work that you and I do, Salmon, would suggest the same thing. And one of the stats we use commonly is what we call a price to earnings multiple, or price of a stock compared to what it earns. This is a value line composite measure. It involves about 1,700 stocks around the world, and you can see as it bounces between 19.5 to 20 every week, we get an update on this number. We're about 3.5 points behind the long-term average, which is around 16.5%. So this really just reaffirms what we're hearing from our managers who are on the front lines, that, you know, damn it, Tom, it's hard to find cheap stocks these days. The numbers would bear that out. Now that is what we rely on our managers to do for our portfolios and yours. Connor Clark and Lunn on our income fund. Gord O'Reilly, the O in CGOV, and his team runs the equity fund. Our friends in Edinburgh Partners in Scotland do the global, and of course Joe Sertivan and his team at Galibier manage the small cap fund. And clearly they're conscious of all these factors, and they're scanning the world looking for securities they think are going to do well in potentially more turbulent waters going forward. Now, just a reminder, how do you fare through all of this? Well, it's a collaboration that we're working together with you, so you do have some duties. You want to make sure you're fresh on what your goals are, the purpose of the money, what's your time frame. Clearly, if you look to the right side of this chart, you're delegating us to find those, in this case, 4 managers who are going to pick the stocks and bonds, assess risk and return. And the middle area is an area that we're just happy to work with clients whenever they want us to help assess their risk, figure out an asset mix, perhaps generate an income for their portfolio if they're retired. And we encourage you, don't hesitate to call or set up a meeting if you'd like to talk about that area. That's what we're designed to do, and we love to do it. Needless to say, as we go forward, we're going to provide a steady hand. We have in our first 10 years, and no matter what kind of markets we have ahead, we do think over time we can generate good returns and provide that steadiness that you need going forward. Now, in wrapping up, I want to encourage you that if you want more detail, please read our quarterly report. There's all of this and more in that report. And if not, give us a call. We'd love to talk about what you've heard today. Thanks for listening.